During the quarter, we saw global markets shift in their sentiment from one of more an opportunistic outlook to further nervousness and caution given the developments around geopolitical issues, tariffs, and the obvious implications on inflation and cash rates globally. If we look domestically, we've seen a long period of credit spreads being compressed, and that means the level of compensation you're getting to invest in those instruments grind lower until sort of around mid-February, where those have started to now push wider. From our perspective, the way we're approaching that is that a lot of the capital that we're getting in to the fund today is going to invest in existing lenders where those credit spreads and those levels of compensation have been pre-agreed. But us also thinking very carefully around the level of growth that we want in the fund and ensuring that we're not being forced into deploying capital into inferior deals. So the outlook for the markets remains one of heightened caution and ensuring we're staying true to label in how we manage the fund. We are seeing more funds enter our space, and really that's through a breadthening of their mandate. So they're not traditional players in our space, but really looking to come into this area to enhance their yield profile. While this is a natural development, our response is very much to stay a specialist in the area that we are and ensuring that we maintain our standards in the face of this heightened competition. And when we talk about maintaining our standards, it's not just around our credit profile, but it's also ensuring that we're investing in capability, technology, and analytics to accurately identify the pools that we're investing in and ensuring that we're managing them appropriately. We are at the most challenging point in the cycle as a credit investor. We've got a period where credit spreads have been compressed, as well as the outlook having a range of different risks that we're thinking about from a portfolio perspective. The temptation in light of that is to obviously get higher returns by going to areas that offer slightly higher risks. So it's very important that discipline in the investment process prevails and a clear focus point for our investment committee that reviews our investment decisions on a monthly basis. Over our 10-year history, there's been a number of geopolitical and local developments that we have closely monitored and ensured that our investment process was dynamic to react to and deliver on our investor expectation of the RBA cash rate plus 5% net of fees. Today is no different in that way. We are very deliberately thinking through the implications of the economic outlook as it stands at the moment and adjusting the portfolio, the most notable being that there are no consumer loans in the Manning Monthly Income Fund at the moment, given our concerns around the cost of living pressure that is prevailing at the moment. So we feel we are well equipped to continue to navigate these times. We see the increased scrutiny on the asset class, both from a regulatory perspective, but also a media attention is a healthy dynamic and not entirely unexpected. Through our years, we've conducted a number of overseas research trips, and if you look at markets such as the American market and the European market, where credit, both listed and unlisted, is a far larger and more developed asset class, that has been a very similar thematic in terms of how it's moved from very much an infancy stage through to a more institutionalized offering. The benefit for investors in this is that to prevail in a more sophisticated, highly governed environment takes a higher quality counterpart. So I see this as a really healthy dynamic from an investor's perspective. We've touched on a number of things that we're looking at. Clearly, geopolitical developments, tariffs, inflation growth, and the implications on cash rates globally are a key thing that we're watching. Domestically, it's very much around the consumer, the employment market, and how resilient those different subsectors of the consumer sentiment or the population are, and the implications for what that means for different business cohorts or industries is clearly a key thematic. For us, it's not just thinking about those forces, but what are the implications upon the portfolio and ensuring we're managing it in that light and steering the portfolio clear of those areas. Manning has been managing this strategy for now coming up to 10 years. And in that time, there's always something that we have been thinking about, watching and monitoring. Today is really no different. The thing for us is really we are very much a specialist wholesale fund manager, and we want to retain that more boutique nature. And we think that's a real asset. By being more boutique and not a large scale manager, we can be far more selective in the transactions we participate in. And most importantly, not being forced to go into transactions that offer lower risk-adjusted return. So in that way, we think particularly in this market where there are some things that we are specifically watching, we can be very deliberate in the parts of the market where we want to participate and getting compensated for that capital that we have deployed.